Hey friends, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at technical charts and then try to understand what happened in the market during the previous week and also plan for a better trading week that's coming starting from Monday, day after tomorrow. So let's deep dive. This is a bird's eye view. It's a weekly chart and corresponding daily charts on the right side of the Nifty. You see that it's within two trend lines. It has prices moving that, and now it's at the bottom of the trend line, anticipating a breach. And the daily charts on the right side of the Nifty, you can see that it is once again heading towards the bottom of that trend line channel. Right. Similarly, on the Banknifty, you see that there is a wedge, trend line. Heading towards the trend line is what is happening in the price. And on the right side, the daily charts of the Banknifty is showing that it's tried to recover, and once again it's heading back towards the channel bottom, right, where trend line support could be there. And what exactly was happening? So last week was too bad for the bulls. 2.68%, 632 points got cut in a day, in a week, right? So all the gains that was there the previous 2 weeks are done with, are taken away, and market reversed to surprise because you had 2 green weeks prior to that, and then all of a sudden already morning market closed with a 2.6 big cut, and once again it's back to below the 20 exponential moving average, and the correction is almost the same, 13.3% of correction so far from the high. And remember, it's in a rally of 72% from 2022 onwards. So that's the kind of rally, and it's a 13.3% of retracement that has happened so far. The Banknifty also cranked down, but not as much as the Nifty had done. Banknifty also had 2 weeks of green candles, and all the gains, half of the gains of that has gone. It's 2.13% cut. That's more than 1,000 points cut in a week, and it closed below the 20 exponential moving average. So the correction so far in Banknifty is just 12%, and that's the story in a nutshell. So it was a big crackdown in the markets. So candlestick patterns, if you see, obviously, the candle that you see here is very wide range, bearish candle on Nifty and the Banknifty both. And it is retested and breached and made a swing low, new swing low as well against Nifty, but that swing low is not tested on the Banknifty, but the candlestick as such is heavily bearish, and so there's no doubt on that, right? So we are seeing that the lower high pattern is clearly seen on both indices, right? And on the daily charts of the Nifty and the Banknifty, what you see here is look at the last 7 days or 8 days. So it started from the previous week, from the mid of the previous week onwards. It has been steadily falling, and once it reached that support zone of 22,800, it started bouncing up and down with heavy volatility. So that seems to be a very good zone of support. So therefore, market at this point is cool. The price point is very crucial. Any breach of that would be heavily bearish, right? So that's why market is dancing around up and down and up and down at the same point for the 4th time probably, right? Already did that once, twice, 3 times. 3 times it retested, and and if price goes below the last Friday's candle, then we may have to expect something really bad. Another 5% correction could come in if that happens. And the Banknifty also the same. What started from the previous week, from mid of that onwards, after the right. So to count the number of days, from Wednesday onwards it started and it continued. In between we had a mild greenish attempt, but once it reached that support zone, it started dancing up and down. So candlestick wise, it's wide range, bearish again on the daily and the weekly on both indices, Nifty and the Banknifty. So in a nutshell, what is its continuation of the previous week, that happened last week. It's continuation of the fall, and it broke down until it reached a place and it reached the support zone. It retested that, but a new swing was made on the Nifty. Banknifty also same story, except that it didn't fully retest the previous swing close. No, it may be doing that next week, you never know. But this zone, particular zone, as I said, is very crucial. Now, interestingly, the Bollinger Bands are showing that the Nifty is the bands on the downside expanded with the bearish buyers below the median of the Bollinger Bands, which indicates there's a likelihood that the price can further fall down. But again, the Bank Nifty, you're not seeing that expansion on the downside yet. It is still contraction and absolute sideways. That's the only hope for the bulls, the Bank Nifty, as of now. But yeah, so heavy bearishness all over is what we are seeing, and market is at prices at a very, very crucial zone in the case of both indices. Moving on to the momentum and the trend of the indices. Left side you have the weekly time frames, and right side you have daily time frames. So momentum clearly has is sideways. No, it has still not fallen to the bear zones in the case of medium term. For the daily, it has fallen to the bear zones in the case of Nifty, and Bank Nifty it's not done that. So Bank is less bearish with respect to the momentum and the Bollinger Bands. Momentum and Bollinger Bands on the short term, Bank Nifty is doing okay, but Nifty on the short term has turned heavily bearish with respect to momentum. So, in a nutshell, momentum is sideways, except that momentum has fallen to the bear zones again of Nifty, and the trend is remaining bearish. That's what we make out of it. For the momentum, RSI is used, and for the trend indicator, ADX is used. So the DMI negative zones is where, and the strength of the bearishness is increasing. It's slightly falling, decreasing in the case of Bank Nifty. Bank Nifty is medium term, but bearishness as such in the short term is increasing on both. So that's the story about the momentum. Because the volatility, we can understand some bit of volatility from Bollinger Bands. The expansion on the downside, it's clear. Volatile moves. The further it moves away from the medium of the Bollinger Bands, the greater the chance of increased volatilities. And VIX is another. India VIX is another fear and greed measure, which again is how we track the volatility. So now it's in the medium term volatility. It had crossed over and hit almost 18 during the budget. It had cooled off almost down to 13 and below 13 also, I think. Yeah, so 10% spike is what happened last week. What made the 10% spike all of a sudden? It is most likely the fear and the greed. It's most likely the fear and the greed that happened because of the reciprocal tariffs that Trump had announced last week. Now, the open interest analysis, the next, what you see here, it's a short build-up in the futures open interest as per the Friday's build-up, which is the options that expiry on the Nifty's weekly expiry in February 20th and February 27 Bank Nifty monthly expiry. If you look at that, it's bearish. Bank Nifty is 0.7 and Nifty is 0.6 PCR put call ratio. So options are showing the same bearishness. Now moving ahead, we can try to understand the support and the resistance from the open interest. That's one way. We can also understand it from the charts. We'll go with the open interest first. So open interest for the next upcoming weekly expiry of the Nifty on the February 20th is showing that it's 22,500 and 23,300 were the highest put and call rating received. That's where the support and resistance are the highest. There are 4 more days to complete before the expiry, but that's what people are bet as of Friday. The next second level of writing and call writing is seen at 22,400 and 23,500, where the support resistance is seen. The Bank Nifty for the monthly expiry, 49,000, 50,000 is where the levels are there, where the highest put and call writing is there. The second highest is 48,000 and 50,500. So put call ratio and futures OI is bearish. So that's one way of understanding the levels of the support. Now looking through the charts, that's another way of understanding where the levels are there, where the support resistances could come in. Now we can see, so basically we are making the Fibonacci measurements. We use the previous swing lows, we use previous resistance zones and candlestick patterns, and that's how we derive. So here usually we can, first resistance would be the Fibonacci 61, which was breached, that comes to somewhere at 23,154, and after that the 20 exponential moving average resistance will come in at 23,291. Then the exponential moving average of 50, 200, 100 likewise, right? So the major resistance is going to come in close to the 23,800 mostly. Fibonacci 60, 50 and all that. Downside, similarly, the previous swing lows and the Fibonacci 78 is the major supports could come in, right? 22,340 is where the Fibonacci 78 is their retracement level. Previous swing lows at 22,786. Market bounce, slightly bounced on Friday from there, so that could act as support. If that is breached, then it can head all the way down towards the Fibonacci 78, and then further from there to 22,000 and 21,825 likewise. Similarly, Banknifty, it's in the trend line channel, so you can see that the first resistance would be 49,500. Before that, 49,000 is already climbed, so it's a good thing. Just retain that, close above that now. 49,286 is Fibonacci 61, and then 49,550 is 20 exponential moving average, then 49,850 is the 50 exponential moving average. 50,000 is going to be very good resistance there, because that's confluence of the 200 exponential moving average as well as 50 exponential moving average. So 5,500 after that. So that's the 5,500. If that is cleared, then we bulls may have some hope, right? So that's how. So the levels, the market PSL is previous swing low, previous resistance, Fibonacci 78, rounding number. So that's how supports and resistance of Nifty and Banknifty is put there. Have a closer look. Let us move ahead. So if you look at the different sectoral indices, you can see that it was horribly hit. It was heavy selling that happened across the sector. Not a single sector has gone unaffected. IT sector is 3.8% down. IT is a defensive sector. Metal 4.7% down. Tax tariffs, US tariffs. Auto sector 6% down. Pharma sector 5.8% down. Auto tariffs. FMCG 3.7% down. Realty is 9.2% down. So every sector indices has been heavily hit, and none of them are. All of them have turned bearish basically. All of them have turned bearish. It's no longer sideways. It's short-term bearishness, and others are heading towards the medium to bearish. So this is a chart for that. You can see IT, the bellwether IT was what used to support the market whenever there is a crackdown or a corrections that happen. But looks like IT is also not helping, despite the fact that Nasdaq is made new all-time highs. Right, so IT sector is in the sideways falling momentum, and metal is at the bottom of the trendline channel and consolidating. Climbed back with a divergence, and then in the sideways right now on the medium term. Auto is also a lot of space for it to fall down. It was correcting and continued to correct in deep red, but momentum is yet to fall down in the bear zones, right? And moving pharma has breached that channel and looks like it's heading down, but still sideways momentum. And what FMC got really hit bad, and then it slipped to the peer zones and breached the channel also. So really crucial that it climbs up from here. Deep correction FMCG. Reality, once again, not a space to go down. It is fallen, recovered to sideways, and once again fallen back to the bear zones. So peer zone medium term is seen in FMCG and reality. These are the two sectors that has really gone bad. Others are, seems like they're all heading towards that metal, auto, and pharma, all that, right? Basically, auto, metal, and pharma is just trying to hold on the sideways momentum, but FMCG and reality has given it up. IT also could not help the other indices. If you look at the heavyweight stocks that contribute maximum to the index, right? These are those main three ones, and then we have additionally another four ones. So the main three, HDFC Bank is still sideways, not falling too much, but sideways. Having hit a 1,800 plus, it had hit the top of the channel, and then deserting back, and and then it went into some retracement. After that, it was trying to move up, but Friday last week it had small trouble. Lens once again unable to climb and hold on that sideways. There is a possible divergence. It has almost hit the bottom of that channel. Still some more space. It can go as low as 1100. Another 100 points it can fall down, but it's trying to move sideways and finish the correction in that zones of 1200. This is bank. Small green is sideways. It's not correcting. It is not unaffected by all the drama that's happening in the market. People are holding on with that stocks. As of now, all three heavyweights are sideways. One of them almost breached the sideways lines. Now, index other index heavyweights reinforced in IT. The IT Infosys and IT, TCS IT stocks, they are sideways, and with respect to the momentum, and Kodak Bank always is a contrast stock. It always moves up and down within that range. Swinging just that, and then right now it's on the upward trend. But that's the only stock that's holding the market probably, Kodak Bank, and it is in the momentum bull zones in the medium term. Probably the only one of the heavyweights. Now another one, FMCG stock, ITC, the giant, has fallen down to the bottom of the channel, and momentum has dipped in the bear zones. The only heavyweight that has fallen to the bear zones right now is ITC, because FMCG got really bad, and the FMCG index itself is climbed into the bear zones. So the ITC trouble, Reliance trouble, right? Others are what is holding the market, and Kodak Bank is holding the market from the front. Okay, so that's the story. Now if you look at the broader markets indices, mid cap and Nifty small cap, we can clearly see that it's a breach of the trend line channel, and then just fallen into the bear zones with respect to the momentum, and the trend also has turned bearish heavily. So deep correction has come in, and mid cap and small cap, and then analysts are saying that this could continue. So next stop could be at near to 45, 134 and 50,000. So some quotes come in. That's about it. So momentum has dipped below the 40 minutes. Its bearish trend is rising up. Bearishness is rising up its strength. So broader market indices giving trouble, heavyweights having trouble, and all the sector indices are in deep trouble with big cuts. The bears have taken control. Let's move it and see. The primary reason to rise here. FIS has been selling and doing nothing but selling. 19,000 crores of selling. They had paused a little bit with half of this, around 8,500 selling last week, but this week again back to momentum in the selling. The are trying to compensate and buy, but that doesn't help, right? That's what I say. So FI buying has to come in. That's the only way for the market to jump back and get into the next rally. Other than things will turn out like this only. On the other hand, if you try to understand the global markets, currencies and the commodities, and let's begin with the currencies. It's a 1.24% down. So US dollar index has cooled off. Good thing. Momentum has slipped to the sideways. That's the only good thing. Now USD INR, also RBI has done some magic. Some efforts are put in there, and then it has cooled off 1.16%. That's also a good thing. Rupee has gained some strength, but overall 86 somehow is not good for it continues to be a weak rupee, right? So USD INR, some fall off has happened. Crude oil has also cooling off, which is also good, right? So those are the two things. The crude oil is cooling off, currency has gained. So only two good, and dollar index has cooled off. These are only things good that has happened. But look at gold. Gold has made a new all-time high and hit 2950 something, 443 or something, all-time dollar terms. So it's a breakout. Another fresh breakout has happened following the Trump. Another breakout, and gold is surging up. Means people are shifting the money towards safer havens. No doubt about that. Now, when you say global markets, I mean the US market versus the other market. It was also index. Green overall is green. S&P 500 green. Nasdaq record high. S&P 500 record high. Momentum bullish, rising. Absolute mother market is green and bullish when our market is struggling to stay afloat, undergoing correction. Now, that's about it. That's the story. US market green, good thing. Crude oil cooled off, good thing. Rupee has strengthened, good thing. Dollar has cooled off, good thing. Gold is record high as a hedging instrument, good thing. Overall, global cues are good, but FIs continue to sell. Now, to action for the next. The action in the sense, action is for you to study the charts, right? To go and do the homework and study the chart. It's not a recommendation for you to trade at all. No, disclaimer. And Colgate family is sure short sell because it's an inverted flag. Momentum dipped into the red zones, bear zones, trend crossed out the bear zones. High volume selling, big red candle, risk-reward 1:2 can easily be possible, right? Have tight stop losses though. That's a short trade, Colgate normally. So the long side trade is by the head trail. It's a flag breakout. This is the inverted flag breakdown. That's a flag breakout. Probably the only stock that is having some momentum right now after Kodak Bank is Airtel, right? And have tight stop losses because the entire market is moving down. Probably it may not sustain and it's very close to the all-time high. So be extremely cautious when you go long when the market is going down. Very extremely cautious, and so be very careful when you go against the trend. But yeah, it is showing symptoms of moving. But remember, there is a divergence, negative. No, but the volumes are very good. Very big buying is coming in for some reason that we don't understand, right? So it's a long trend by the Airtel and Colgate. So this is a bull. It's a bear call spread. Bear call spread is completely hedged. Very good profit, and then RiskReward is also reasonable for you exit early, and very low margin, right? Basically you're selling near to ATM 23,150 call, and then to cover the risk you're buying OTM for OTM 23,450 call, right? Buy and sell instead of only selling, or instead of, you're covering. Selling gives you the money, hedging gives you the protection. So any world market falls down, absolutely no issue. How much ever market falls, you will make money. But in case market reverses from here and then goes beyond the 23,300, 200, you have trouble. That is the risk that you have. But so the market is bearish, you can place that bets. That's better than doing call selling. Right? It's completely hedged. They are call spread. The fellow strategy for this is also a recommendation. This for learning purpose only. Check out the graph payoffs on your side and try to understand the logic behind this. Just to wrap it up, the market has cracked down. It has given up all the previous 2 weeks of gain while it was trying to bounce up. It didn't happen, and it has reversed and it has closed in negative deep red. Correction remains to be 13.3 from the all-time high, and momentum is lost, trend is lost. It is all lost to bears. Nifty has continued to do the heavy selling. Right, and that's the story. So in that 70% nearby of rally in a period of 2 years, now it's a correction that has come in, which is just 13 points plus 10, 12 and 13%. It's nothing. More corrections could be expected, and the last correction was 18% plus. So keep that in mind. So we're trying to bucket all the different parameters that's in favor of the bulls and the bears. Very few things for the bulls. The Banknifty seems to have not retested the previous low, so momentum is good as compared to the Nifty. Did not slip to the sideways and flip to the bear zones yet on the short term and the medium term also. The Banknifty has some better strength. That's the only thing. And US markets are green. Then rupee is cooled off slightly, right? And oil also is in the same zones. So that's all of the only things in favor. Global cues are good. Nifty seems to be okay. Right? Apart from that, all things technically, from the chartically, it's against the bulls. It's in favor of the bears. FIs continue selling. Builders, PCR, options, and futures right both are bearish. The price action patterns lower, low, lower, high. That's bad. Sector indices bad. Major indices bearish trend as per the ADX. Momentum is the bear zones already in the Nifty. Heavyweight stocks are all sideways or bearish. Lower markets hit badly and it's in the bear zones. Indices are below the 200 expansion moving average. So have tight stop losses. Right? It's good further intensify is that reciprocal things are going to and it will reveal itself in the coming days. So we have very cautious, have tight stop losses and play safe. Technically market is in deep correction. It tried to recover, failed, try to recover, failed. So it has happened 3 times. That means that zone where it is very crucial, and any fall from here, any fall from the low of Friday could be dangerous. Selling is intense, purposeful selling is what is happening. So it's evident from the FIR data alone for the last 2 months. That's what is happening. Intense selling, non-stop selling. So technically, the view for the next week is more like bearish. Now always keep that in mind. This the technical levels and support, resistance, and all these things is what technical analysis is all about, right? They're not all good if there is any, big bang, what do you call, black swan events that comes in, like the war or pandemic or recession, all these things. Scope technical analysis and things. So that always keep that in mind. That's a disclaimer. 22,000 and 23,500 is the level for the Nifty that I look for the next week. 48,000 and 50,000 levels for the Banknifty in the next week. But this 26,000 and 54,000 is where it has to be, just to climb back in order that it moves to the bull rally. If it has to continue, it is very far from there, right? As I always say, always hedge your portfolio, hedge your positions. Without hedging, don't play in the derivatives at all. And using hedging, you can also make rental income. Check out the playlist for the covered call strategies. Well, that's all I have. Market is bearish. Be careful. And while I say it's bearish, this may be the time where you can do investments in very good quality stocks. If you have derivative, there's a time where you have to buy in stocks which you can pledge and use as a collateral and then trade if you're a trader. But for investors, it's the time to buy not in bulk but in SIPs. As it falls another 5%, buy more. Another 5%, buy more. Right? Don't go for bulk buying because market may become even more, price may become even more cheaper, and this may be the time to make some money on rental incomes, right? Having covered calls and cash secured puts and all that things. Check out the videos on that, right? That's all I have. Subscribe if you like the content. Click the like button if you like it. Give me your feedbacks and share it to others, please. I'm active on other social media platforms, especially the X, and their on daily analysis and details, market views and all that. Right? Check out that. That's all I have. Happy trading, happy learning, happy investing. Bye bye.